Bank meme stocks are shares of banks that have become popular among online traders. They are often driven by hype, speculation, and social media buzz. They can also be influenced by short sellers who bet against them. Why are bank meme stocks volatile? There are several reasons. First, they are subject to the ups and downs of the banking industry, which can be affected by interest rates, regulations, economic conditions, and competition. Second, they are prone to sudden spikes and drops based on news, rumors, sentiment, and market psychology. Third, they can attract a lot of attention from retail investors who use platforms like Reddit or Wall Street Bets to coordinate their trades and amplify their impact. Some examples of bank meme stocks are PacWest Bancorp, PCW, and Western Alliance Bancorp, WL. These are regional banks that used to be too boring for active traders. But that changed in 2023 when they saw meme stock-like trading activity. According to the Wall Street Journal, both banks were falling and battling rumors of an encroaching FDIC death. This made them a tempting opportunity for the r/Wall Street Bets crowd, who saw them as undervalued and oversold. However, not all bank meme stocks are doomed to fail. Some of them can benefit from the meme stock phenomenon, as it can help them raise money and survive financial distress. For instance, AMC Entertainment, AMC, a movie theater chain that was hit hard by the pandemic, was able to use its meme stock status to sell shares and pay off debt. Similarly, some bank meme stocks may be able to leverage their popularity to improve their operations and performance. In conclusion, bank meme stocks are a new and exciting trend in the stock market. They are volatile, risky, and unpredictable. But they can also offer huge rewards for those who can tolerate their swings. Bank meme stocks are shares of banks that have become popular among online traders who are looking for quick profits. These stocks are often volatile and risky, and may not reflect the true value of the underlying businesses. Before you buy any bank meme stocks, you need to assess your risk tolerance and investment goals. Here are some steps to help you do that. First, you need to understand what risk tolerance means. Risk tolerance is the level of risk you are willing and able to take with your investments. It depends on factors such as your time horizon, your financial situation, your personality, and your emotions. The longer your time horizon, the more risk you can afford to take. The more stable your financial situation, the more risk you can handle. The more adventurous your personality, the more risk you may enjoy. The more calm your emotions, the more risk you can cope with. Second, you need to determine your investment goals. What are you trying to achieve with your investments? How much money do you need, and when do you need it? How important is it for you to preserve your capital or generate income? How flexible are you with your plans? Your investment goals will help you decide how much risk you need to take to reach them. Third, you need to match your risk tolerance and investment goals with an appropriate asset allocation. Asset allocation is how you divide your portfolio among different types of investments, such as stocks, bonds, cash, and others. Different assets have different levels of risk and return potential. Generally speaking, stocks are more risky, but offer higher returns than bonds or cash. Within stocks, bank meme stocks are more risky, but offer higher returns than other stocks. Fourth, you need to review your risk tolerance and investment goals regularly and adjust your asset allocation accordingly. Your risk tolerance and investment goals may change over time due to changes in your life circumstances, market conditions, or personal preferences. You should monitor your portfolio performance and rebalance it if it deviates too much from your target asset allocation. By following these steps, you can assess your risk tolerance and investment goals before buying bank meme stocks. This will help you make informed decisions and avoid unnecessary losses or regrets. Bank meme stocks are shares of banks that have become popular among retail traders who use social media platforms like Reddit to coordinate their buying and selling activities. These stocks can experience high volatility and sharp price movements, which can create both opportunities and risks for investors. In this section, we will discuss how to diversify your portfolio and use stop-loss orders to protect yourself from sudden price drops. Diversification is one of the most important strategies for managing risk in the stock market. By spreading your investments across different sectors and industries, you can reduce the overall risk of your portfolio. This means that if one of your holdings suffers a large loss, it will not have a significant impact on your overall performance. Diversification can also help you capture the benefits of different market trends and cycles. Portfolio holdings can be diversified between and within asset classes by investing in both domestic and international markets. Diversifying your holdings among a number of commodities will allow you to at least somewhat offset the losses from one of them. You should also choose the right asset allocation strategy that matches your investment goal, risk tolerance, and time horizon. For example, you can pick between strategic asset allocation and tactical asset allocation strategies. Strategic asset allocation is a long-term approach that involves setting a target mix of stocks, bonds, cash, and other assets based on your expected returns and risk preferences. You then rebalance your portfolio periodically to maintain your target mix. Tactical asset allocation is a short-term approach that involves adjusting your portfolio mix based on current market conditions and opportunities. You then revert to your strategic asset allocation when the market situation changes. Another way to protect your portfolio from volatility is to use stop-loss orders. A stop-loss order is a type of order that automatically sells a stock when it reaches a certain price. This can help you limit your losses and lock in your profits when the market moves against you. Stop-loss orders are especially useful for bank meme stocks, which can experience large price swings in a short period of time. Stop-loss orders come in three main types: standard stop orders, stop limit orders, and trailing stop orders. A standard stop order is triggered when an execution occurs at or below the stop price. When this occurs, a market order to sell is executed at the next available price. A stop limit order is triggered when an execution occurs at or below the stop price. When this occurs, a limit order to sell is executed at the stop price or better. A trailing stop order is triggered when the stock price falls by a certain percentage or dollar amount from its highest point. When this occurs, a market order to sell is executed at the next available price. Each type of stop-loss order has its advantages and disadvantages. A standard stop order offers execution protection only, not price protection. This means that you are guaranteed to sell your stock once the stop price is reached, but you may not get the exact price you wanted. A stop limit order offers price protection only, not execution protection. This means that you are guaranteed to sell your stock at the stop price or better, but you may not get your order filled if the market moves too quickly. A trailing stop order offers execution protection only, not price protection. This means that you are guaranteed to sell your stock once the trailing amount is reached, but you may miss out on potential gains if the stock rebounds. To use stop-loss orders effectively, you need to consider several factors such as the volatility of the stock. The more volatile the stock, the wider the stop-loss should be to avoid getting stopped out by normal fluctuations. The trading volume of the stock. The higher the trading volume, the more likely the stop-loss order will be filled at a favorable price. The time frame of your investment. The longer your investment horizon, the less likely you will need to use tight stop losses. the risk-reward ratio of your trade. The higher the potential reward relative to the risk, the more aggressive you can be with your stop losses. Using these factors as guidelines, you can set your stop-loss orders according to your personal preferences and risk tolerance. You should also monitor your portfolio regularly and adjust your stop-losses as needed. You can also use trailing stop orders to raise your stop prices as the stock prices increase, allowing you to capture more profits while protecting yourself from downside risk. In summary, bank meme stocks can offer attractive returns, but also pose significant risks due to their high volatility. To manage these risks, you should diversify your portfolio across different asset classes and sectors, and use stop-loss orders to limit your losses and lock in your profits. By doing so, you can increase your chances of success in trading bank meme stocks.